Tell me if you've heard any of these before. We can get you a much lower rate than anyone else. You'll skip 2 payments. Lock it today or it's gone. Don't shop. Your score will tank. We'll do a free refi when rates drop. Guess what? There's no out-of-pocket cost. We'll even refund your impound account. Here's the thing. Every one of those lines can technically be true, but they're often used to manipulate you, not to inform you.
100%, Jeb. This is really a greatest hits of all of the crazy things that people tell me loan officers have told them. And the thing is, our audience here, most of you listening, first-time home buyers, you haven't been through this process before. Even if you're not a first-time buyer, you went through it 5 years ago, 10 years ago. This isn't something you do regularly. We've talked on the show how the mortgage business, real estate also, it's an 80-20 industry. 20% of the people do 80% of the business. That bottom 80% is a varying degree of incompetent to indifferent or new or learning or just outright meant to mislead you. So we talk a lot on the show. We get questions on the live show. We talk here. How do you shop for a mortgage? How do you know when you're getting the right answer? So we're gonna close with that and kind of give you a walkthrough of what that pre-approval rate quote process should look like. But we're going to start with some of the crazy red flags that if someone throws this out to you, it is more of a script or a sales pitch or a line akin to a used car salesman versus an advisor that is really trying to get you the best terms.
Yeah, how to know when a lender's full of shit is basically what we're telling you here. I mean, we're getting down to the nitty gritty. So Josh, there's 2 types of processes, if you will, that where you can get quotes and talk to multiple lenders. One, you're purchasing a home. That's a lot of our audience here. First-time home buyers going through the home buying process, navigating it for the very first time. So they're not familiar with these tricks, if you will. The other side is refinancing. A lot of we have an audience here that purchased a home. They're still with us. They like the show. They just want to stay up to date on what's happening in the market. And those people are looking to take advantage of a lower rate. So I think let's break it down into 2 different sections. One, talking the purchase side, some of the things you're likely to hear, maybe some of the things that you're likely to hear on the refinance side, and then what the process should look like regardless of which direction you go.
The big one over the last two years is really a combination of 2 sales pitches or 2 lines. This idea of marry the house, date the rate. Rates are not historically high, but they're very high relative to where we were for the better part of the last 10 years prior to the last 2 or 3 years. So a lot of people adopted this pitch. This is an aberration. This is short term. Just get into the house. You're going to date the rate and we're going to refinance and get it to you lower. And then the combination, the kicker on that is we do free refis for our past clients, which, is it true? They will do the loan with no cost to you, but it's either no out-of-pocket cost, which we'll talk about in the refinance, meaning it's rolled into your loan, or they're doing it none of their cost, which is generally fairly minimal. It's box A fees. You're still paying escrow, title, appraisal, any of those required things. Because the reality is, if a loan officer does 100 loans in a year when rates are high, and then we get a short 2-month window where rates drop, they can't do 100 refinances for free and make no money. They would lose their mind and make no money. It just defies logic. There is overhead. There's a cost. All of the cost in a loan is not profit to the lender or the loan officer. So if anyone's telling you things, marry the house, date the rate versus, hey, let's buy with the hope and expectation that we're going to have a window to refinance. And we can talk about what it would look like at a 0.5% lower rate, 1% lower rate, but we got to be comfortable that you are good with this house payment if it never gets any better.
Yeah, I think the biggest thing for me in that whole, Josh, is the whole free refinance, right? There's no free lunch, right? I mean, we've heard that since we were kids. And the idea is that you're either taking a higher interest rate than the best interest rate in the market, and they're subsidizing your cost. So yeah, you might not be paying that cost out of pocket or maybe in your loan amount. Many times you are doing both, but you're paying for it in a higher interest rate, and they're just taking that and giving you essentially your own money back in order to cover the cost. So it's important to understand it so that when you're hearing these terms, free refi, no out-of-pocket costs, no closing costs, all of these things, you can differentiate what that lender is saying versus what you're actually getting at the end of the day. Now, another one, Josh, that we, kind of goes hand in hand with the call centers and the people out there that don't necessarily do a lot of business and are trying to trap people into only working with them, is this whole idea that, hey, don't go out and shop a bunch of lenders and have them pull your credit because your credit score is going to drop. And we don't want your credit to drop. And honestly, that's probably the scariest thing I think for home buyers, is this idea that their credit score is going to drop because they're shopping around.
Absolutely. The mortgage scores are set up. You can go to the CFPB's website, just search for how many times can I pull my mortgage credit within 45 days, or how long do I have to pull mortgage credit, and shop lenders. And the CFPB's link will come up number one, and it says you have 45 days. And there's a reason for that. A mortgage is a very important purchase, likely the largest debt that you're going to have. They want you to have the ability to search to find good terms. So anyone telling you don't search because it's going to put you in a bad situation, first of all, if they were the first to pull and everyone after that is getting a lower score, then they should be like, hey, go have it pulled 50 times. By the time you get to the end of that line, your credit's going to be so bad, I'll be the only one that can do your loan. So it's ignorant, it's manipulative, it's dumb all the way around. Just think of it this way. If you go and have your credit pulled for credit cards, 10 different credit cards, you might open 10 different credit cards. It would be very rare that the consumer goes and has 10 mortgage inquiries and pulls out 10 mortgages. They're going to take one mortgage. Everyone knows that. It's not a sign that you're out seeking for credit or you're in financial trouble. It's a sign that you're trying to make an important financial decision.
But here's what I'll tell you, Josh, is the more people you talk to, the more confused you're going to be from a consumer side. So it's important to shop rates. It's important to compare lenders. But I think 2 to 3 is probably what you need to do. Talk to a broker, maybe talk to your bank, like that sort of thing, versus going online, putting your number into some, website that you have no idea who they are, and you're going to get calls from 50 different people. Because what I will tell you is, being in the mortgage business for over 10 years myself, and hearing you bang your head against the wall, it's a difficult conversation to have because people get things confused. They don't understand what's going on, and that only gets worse with the more people you speak to.
Yeah, we get this all the time. Hey, you guys talk about it on the show, I have to get 2 or 3 quotes. And it would be self-serving for me to say, except for me, I'm the only person in the world. Talk to me and don't shop. So if you feel that need, I get it. I know who we are and we're uniquely positioned, but I understand that if we have a conversation, you want to get that, 1 or 2 more calls. Check with your bank, check with your credit union, see what the numbers look like. They're going to be very different experiences. They're going to be very different experiences if you call 3 different brokers. So we'll go through that of how you're going to make that decision of who you should work with. So along those lines, if you're shopping around, you're looking, interest rate is important, but if you lead with, hey, I'm shopping around for the lowest interest rate, you are telling the shark salesperson, how do I pitch this person? How do I manipulate this person? So if they're telling you, we can get you a lower interest rate than anyone else. The reality is, as a broker, we have 70 different lenders. I have a program called Loan Sifter that we go into. I put your terms in, it brings all of them up, and it's pages upon pages. And there is a huge difference from the best to the worst, but the top 10 are all really similar. And guess what? I'm not the only one that has access to them. Every other lender has access to them. So everyone sets their own pricing, their own markups on that money. That's the wholesale cost of the money. So there can be differences, but if someone is telling you they're substantially different, like this is what I tell people. If someone is more than an eighth higher than I am, I got to question what they're doing. They're trying to make a ton of money on you. If they're more than an eighth lower than I am, I got to question if they're telling you the truth, because unless they have a proprietary source of portfolio money out there that they can lend at whatever rates they want, all of these loans go into the secondary market. They're going to be in a pretty narrow range. We talk when you're shopping rates. I've got a listener right now, Anshu is awesome. He sends me every couple of days, hey, this is what Mortgage News Daily is quoting. Where would I be today? And it's never too far from that. So we talk about search Mortgage News Daily. They have a rate chart that tells you conventional loans, FHA, VA, jumbo, 15 years, and it gives you a very good idea of where the market is at. If someone is massively different than that, higher, definitely run. If they're massively lower, hey, how do you have access to this lower rate? And maybe they say, well, I work for a bank. We have a small portion of portfolio loans that we use our own funds and we set the pricing on. It's about the only case where you're going to see something significantly out of line with that. So typically it's a red flag if someone is giving you massively different numbers than what you're seeing. And you can use Mortgage News Daily. You can use the Optimal Blue Mortgage Market Index. You can Google either one of those. They're going to give you accurate numbers that you can usually do a little better than. People will tell me, I had a client, Jeb, the other week, reached out, client I've done 15 loans for. And she says, well, I went on Bankrate, and Bankrate says for this, that the rate should be 6.5. And at that time, 30-year fixed rates were at like 6.82. I said, Susan, you are buying a 4-unit building, non-owner occupied, and you just told me the rate is 3/8 lower than what it would be for a 30% down single family conventional purchase with an 800 credit score. So Places like Bankrate, any of the places where you put in your information and you get multiple quotes, or you can look at all of these quotes. You can see a rate chart, a rate table. The only way those people get inquiries is to quote the absolute lowest rate in the world. And then it's how do we back off of that when we get it in the door, because there is no margin at those numbers. So start with Mortgage News Daily or Optimal Blue to give you an idea of where rates are at.
Well, just to go a little deeper on that, Josh, from the outside looking in, people can quote insanely lower interest rates than someone else and it be accurate. The difference is the cost that you're paying in order to get that rate. And I think that's really important is like, hey, if I'm a mortgage lender, Josh is a mortgage lender, and you come to me and I say, I'm giving you 6% today, and you go to Josh and he's 6.5%, you're naturally going to want to gravitate towards me because I'm a 0.5% better in interest rate. But what you haven't seen or what you haven't understood yet is that, yes, I'm quoting you a 6% interest rate, but I'm also quoting you a 2%, buy down, if you will, in order to get that interest rate there. So, on your $1 million loan, you're paying $20,000 to get that rate. Again, I'm making up the numbers here just to make a point, but it's not just about the rate, guys. It's about the fees that are associated with that rate. And we can talk about it more when we talk about refinancing, but it goes even deeper than that. It's the communication, it's the rapport, it's the understanding of the information and be able to convey that to somebody in a way they can understand and feel comfortable with it.
100%. Jim, I was on a training call when we had rates really low last fall, and they were saying, "Hey, we have a way of structuring this and showing you how." So I was on there, but they brought a sales coach in there, and he says, "This is what you got to understand. If someone's talking to Rocket, if someone's talking to Veterans United, they see something online, they never quote 0 points. So if you're leading with the greatest 0-point rate on the planet, it is never going to sound as good as the call center guy talking about a 1.5, 2.5 point interest rate." And that is exactly what we see on these refinance quotes. Very few people go to the call centers for their purchases, but on refis, a lot of them will end up there. And I can tell them, "Cool, you got an awesome rate quote. There's a 5.5 VA refi, 5.5%. Say, how many points are you paying for that?" "Oh, it looks like it's like 2.25. And you're like, "Dude, you have an $800,000 loan. You want to pay $20,000 for a $100 lower monthly payment? It's going to be between now and forever for you to recoup that." So it's very important. This one, the last one, Jeb, there's an element of truth to most of these. Hey, this number, I can only do this number today. That rate, it's an amazing rate. We got a special deal. We got to lock it.
You sound
today.
like a car salesman, bro.
I sound like a car salesman, but some of these guys are smooth. They know how to deliver that pitch. The truth of the matter is interest rates do change. They change multiple times through the day sometimes. It's been very calm here for the last couple of weeks, so we haven't seen that. But when the market gets volatile, we can get 2, 3, 4 reprices better or worse during the course of the day. So it is true that rate is only good for the moment that I'm talking to you. But this is an important decision. If someone's trying to put pressure to you, you got to make this decision right now. I mean, it is incredibly rare that I'm looking at the market and I'm looking at the bond charts and I go, "We got to make this decision now. Things are going bad and going against us." It happens, but it's very, very rare. So those would be the big ones on the purchase side that are tip-offs that you might be dealing with a salesperson and not a mortgage advisor.
And if we could be of assistance in this process, maybe you've already got a quote, maybe you're trying to get a quote, want to see where you stand in the market, reach out to our team. We're helping hundreds of people here on YouTube. Would love the opportunity to guide you through that process. Again, the process is free. There's no sales pressure here. It's about educating, guiding, providing you with information, and letting you make the best decision for yourself. If we could be part of that, we would love to. The link in the description, theeducatedhomebuyer.com/start will get you in touch with the team. So that's kind of the purchase side, Josh. Before we talk about what that process looks like, what you should compare when you're talking about these kind of like apples to apples, or maybe you're a vegetable guy, an avocado to an avocado's a fruit.
Also a fruit.
Piece of
Don't
celery.
go tomato. Tomato's also fruit.
Yeah. Piece of celery to a piece of celery. If you're one of those people, we're going to talk about that. But let's talk about the refinance. We'll hammer through these real quick. First one we're hearing a lot of at the moment, or I'm overhearing you have this conversation a lot, is this idea that you're going to be able to skip 2 payments. By refinancing with me, I'm not only going to save you interest rate and I'm going to save you money per month, I'm going to save you some money everywhere and all these fancy things, but you're going to skip 2 payments. And hey, my payment's $5,000 a month. That's $10,000, dude. I'd love to skip 2 payments.
So the mechanics of the loan, Jeb, today we're recording this, it's early in the month. So let's say we record on the 10th, but you haven't made your payment for the previous month. Okay, so you're not making that payment because it's included in the payoff. And then everyone knows you don't make a payment the first month because the lender wants a full payment. So if you close on the 10th, there's 20 days left in the month. They don't want a 2/3 payment at the beginning of the next month. You're going to skip that payment. So the mechanics of it, you are not writing a check. You're not going online. You're not paying anyone for 2 months, but there is no free ride. You're going to have the current loan all the way through closing. And then that new loan, you're going to have starting there and pay interest on that. So every day that you own the home, you are accruing interest. We can include that interest in your new loan amount without it being considered cash out. So you're not skipping anything. You're essentially doing a mini cash out loan and adding that on to your loan amount. Yeah.
Josh, I want to jump in here real quick. Most people don't understand when you make your mortgage payment, you're paying the interest from the previous month, right? And so what you're doing is when you're closing on a loan, you're closing if on the 10th, you're paying the interest for that month, and you're skipping that next month because of how the interest is paid. So when they're telling you that you're skipping 2 payments, all they're doing is prepaying that interest up front and probably rolling it into your loan versus you paying it out of pocket. It's just a sales tactic. It's just a way to help them differentiate themselves from the next clown out there.
Yep. And the next one is sort of a corollary, goes along with this. Hey, and looks like, hey, you got a big loan. You got $9,000 in your impound account for your taxes and insurance. You're going to get a refund of that within 30 days of closing. And you go, okay, that's true. When it closes, you will get a refund from the previous lender. But guess what? If we now don't have an impound account, how do your taxes get paid when they come due? How is your insurance renewal paid when it comes due? Well, one of 2 ways. You're going to take that money that got refunded to you and you're going to make the payment yourself, or we need to establish a new impound account, and it's going to be magically almost exactly what's in your current impound account, sometimes a little more. So again, that can be added on to your loan amount, but this is what we're doing. Most people that call me to refinance aren't looking at cash out. Some are, and some people just need a little bit of cash out. So these tools can be ways of manipulating the process to use a rate and term loan to skip 2 payments and get your impound back. I had a client, a listener to the show last fall, Jeb, that we were able to do this. They had done a bunch of renovations. They went 25 grand over budget. It was a $900,000 loan. By skipping 2 payments and getting their impound back, they got $31,000. That made them whole. We were able to call that a rate and term loan and not do cash out and get the worst terms with cash out. So there's a time and place, but it needs to be strategic because you are going to be playing this. So Jeb, like I said, this is sort of a greatest hits of the call center bullshit lines that get thrown out to people. This next one came in a templated email to a listener that reached out last weekend. And he says, well, I got a much lower quote than that. I go, okay, I know what they're doing. They're, offering you a much lower interest rate with paying a bunch of points. I said, send me what they sent you. They did not send him an estimate of any sort. Not a fee sheet, not an official loan estimate, nothing. They sent a scripted, templated email, and it said, you automatically skip 2 payments. Not true. You're going to need to skip at least 1, but you don't have to skip 2. So automatically was bullshit. We're going to get a refund of your impound. We just went through that. And then he had told me, no, it's a no-cost loan. And it says there, right in bold letters, there are no out-of-pocket costs for this loan. You notice the difference between me telling you there are no costs and me telling you there are no out-of-pocket costs. All they meant is we are going to roll everything into the loan. The 2 points you're paying for the interest rate, the $3,500 in fees, the 2 months of payments, the impound account. So for this guy, that amounted to $34,000 that they were adding to his loan amount. And the difference between no cost and that loan was $125 a month. So I said, for $125, do you want to add $35,000 to your loan? Which, by the way, was a VA loan. He had put 0 down. So he already had little to no equity in the home. And now we were going to go $35,000 higher than that. So this is the stupid stuff. And you guys are smart. When I told him that, he said, thank you for telling me. I knew it was bullshit, but I didn't know why. It just didn't sound right. So you know this. Red flags are going off. Kind of the last one, Jeb, is more of a rebuttal to something that you may ask. Most of the people doing a rate and term refinance now, if you did your purchase in 2020 or 2021, you have an amazing interest rate. You're not refinancing for a rate and term loan. So if you got a higher rate in 22, 23, 24, you are just a couple of years into that loan, but you've made 20 payments on that. So people will ask, well, this is a 30-year loan. Do I really want to start back? Oh, yeah. We want to start back at 30 years to get you the maximum savings. That's true. You will save more money on the monthly payment if we go from the 28 years and 2 months remaining back to 30 years. But you literally just gave up 30 months of payments, 34 months of payments. It's generally a very small difference between those two to keep you on track and moving towards mortgage freedom. We absolutely want to minimize your cost of homeownership and lower your monthly payment, but not at the expense of dragging it back out. First time homebuyer median age, Jeb, the last number we saw was like 37. If you never extend that with a refinance, you're going to be 67 before you have that thing paid off unless you make extra principal payments. This is more important than ever, and very few lenders will talk to you about it.
No, it's good. I mean, yeah. I mean, I have been fortunate to refinance a couple times over the last couple of years, and you go back in at the same term. So you can whatever the term is remaining on the balance of your loan, 5 years, 25 years, 27 years, whatever, you can ask, hey, what is the payment, based on this same term? And now maybe the savings aren't going to be as high as if it were a 30-year term. But if your plan is to pay off that house, then you probably want to go back in at that same term. Now, if you know for certain that you're going to be selling that home in 2, 3, 5 years, then maybe you go back into the 30-year. You get the max savings and you take advantage of it. But it's all about knowing what your plan is. And the guy in that you're talking to, the loan officer, the professional, should be asking you these questions to help you, figure out what the right path is, not telling you that, hey, you need to go back into a 30-year. So Josh, we've talked about purchase, talked about refinance. Now let's talk about what the process should actually look like. But before we do that, I'd like to take a minute and ask a favor. If you find any value in this at all, maybe forward it to somebody who's looking to buy a home. The best thing we can do in order to grow the show is get more people like you sending this to other people. And ultimately, we want to create educated home buyers. So if you're finding any value, make sure you share it, hit the thumbs up, and hit that referral link if we can actually guide you through the process in any way. So Josh, what does it look like if you're talking to somebody who's trying to compare rates? What's important?
So it's important to know a lot of the people that reach out to us from the show, or they reach out from your videos. So there's someone who's trying to educate themselves. So they're not necessarily going, what's your lowest interest rate? What's your quote? What can I do on this? It's, hey, I want this outcome. How do I get there? And that's what the first call should look like. It shouldn't be focused on products. It shouldn't be focused on interest rates. We should have a conversation about what do you want to do? I want to buy a $350,000 home. Okay, cool. In your area, is that a single family home or a condo? Oh, we can get single families here. Okay, cool. Single family home, this area. And how much do you have to work with for your down payment and your closing costs? Because a lot of people I got 3% for my down. Okay, well, cool. Do we have enough for the closing costs? We want to go through all of that. We're going to ask you your credit score. We're going to ask you your job situation. Make sure there's 2 things we're doing there. Making sure there's no red flags or things that we need to be worried about in terms of qualifying you. And also mentally going through, this is the documentation that we're going to need to do a full pre-approval. We're going to do sort of a quasi pre-qualification because we've gone through the numbers. Now I know, okay, it sounds like you make plenty enough money. We have enough money. You went through the scores over 680. So we're good, not the best, but they're good. We can do that. So we're going to have a conversation and say, hey, at 685 with 3% down, I want you to look at conventional versus FHA. That's another red flag. I get this all the time. Well, someone else told me I don't want to do FHA, or someone else told me I can only do FHA. And almost always, at least 90% of the time, it is the exact wrong advice. It doesn't have to be. It's just magically they have the ability to give that wrong advice. So what we want to do is then gather the documentation that allows us to confirm everything that we've talked about, that you are correct of how long you've been on your job, what your income is. Qualifying income that an underwriter is going to calculate is different than what you think in your head is your income that you're going to get next month on the 2 paychecks that come through. So those are the things we're looking at. Now that we have all that, the important next step is a side-by-side comparison of all of the loans that would meet your objective. Sometimes, a borrower's putting 20% down. I talked to borrowers this week, 800 credit score, 20% down. They're not buying in a USDA eligible area. Not that that would be super attractive to that person, but it's a conventional loan. So we're going to look at a couple of different options of conventional loans. But most of our first-time buyers, it comes down to here's what FHA would look like. Here's what conventional looks like. And we always start with a baseline of a 0-point loan. If you tell me, hey, I've got more money, you saw how much my assets are, I've got more money, I'm maybe interested in buying that interest rate down. Okay, cool. We looked at this and we've decided that FHA is the appropriate loan for you. And now you're asking me, what would it look like if we pay points? Now we change that side by side comparison. So we have 2 FHA options, 3 FHA options, different rate, different point structures. I'm not steering you. I'm not pitching you. I'm not trying to make the interest rate look better. We are educating you on all of your options so that you can make the best decision for you and your family. And the only way we can do that, Jeb, it's a lot like what you're doing on the real estate side is I got to ask some questions. What's your life situation? Okay, you're married. How long have you been married? Oh, we got married 2 years ago. You have any kids? Oh, we're pregnant right now. Okay, or we got a 3-year-old. Okay, so where do schools come into this? Do you plan on having more kids? Because you're telling me you can get a 2-bedroom house and you'd be cool with that. Well, there's 3 of you right now. Do we have more kids coming? We got to plan and take the big picture into account. It is not about selling you a mortgage. It is about understanding you, your goals, your needs, your constraints, which is your income, your assets, your credit, and then helping you decide which of the mortgage options exist out there in the free world to, or I guess just the United States, Jeb, to meet your goals and objectives of homeownership.
Yeah. I think that's important, right? It's about having a professional, not having someone that you feel like is trying to sell you something in the process, right? It's information, it's education, it's guidance, and you should walk away from that conversation feeling like you have a pretty good grasp of what the options are, and nobody telling you what you should be doing versus you may be asking, hey, what do you think? What would you do? That's the better direction versus, hey, I'm being told to do this and that's the direction I'm going. So I feel like that's a good place to start. Josh, did you have something you want to add to that?
Well, just what you said something there. People will ask me all the time, what would you do? And I go, I don't know that that's the right question to ask. I'm a 52-year-old man. I've owned my home for 25 years. I own 3 or 4 different rental properties. I'm probably 12, 15 years away from retirement. My whole life situation is very different than yours. If you're a 38-year-old first time buyer, newlywed, expecting your first child, even things like when they say, well, should we lock the rate? What would you do? Well, it's very, very different. I'm in front of a computer with the rates up in front of my screen all day. I get 2 different services that notify me anytime there's a small movement in interest rates, better or worse. So I can stay on top of that very, very closely. And I will, of course, do that for you, but I can't look at it as closely as I would if I'm considering this for my own loan. And then more importantly, the risk tolerance. I always got to ask my clients, are you a gambler? When you go to Vegas, you jump off the plane and you're putting money in the slots at the airport, or you can't wait to get to the Bellagio to go do some shopping or sit by the pool. That's going to inform the decisions that we're going to make for you. So it really should be an advisor role, a consultation. So by all means, the shopping process of you talking to multiple lenders is to make sure you're in the range. You can also accomplish that by looking at Mortgage News Daily, looking at Optimal Blue. The most important thing is getting great terms on the absolute right product versus the best terms on something that's totally wrong or structured wrong for you. And most people don't get that right. But you are the educated homebuyer. You're here listening. So now you have all the information you need to make the best decision for you and your family.
Yeah, and if we can be of assistance to you, make sure you reach out using that link in the description there. I mean, I realize this probably feels like a lot. And the reality is you're not alone. Like a lot of our audience feels the same way. It's a deep conversation. It's guidance. It's going through all of that information. And it's really, when you hear it the right way, it's not confusing. It should lay out pretty simple and it should be in terms that you can understand. So with that said, we'd love the opportunity to continue to guide you. If you have questions, make sure you put them in the description below. But here's a question for you guys. Which of those sales tactics that we listed at the beginning have you actually heard? Maybe all of them, but what's the one you heard most recently? Let us know in the comments. But until next week, make sure you buy right, borrow smart, and build wealth. Adios.
Amigos.